All right, hello everybody, and welcome to Coffee with Mark. Marcus is not with us today, so I decided to fill in for him, and we have a great session where we're going to talk about the fear index or the fear gauge. What that is telling us, what the information we have is about this index and numbers to consider, how it works, but also what sort of extremes we have that we need to pay attention to. So let's go ahead and get started.
This show is about real money and real trades. I'll show you the trading strategies that I personally trade, the tools that I use to trade my own accounts, and we will talk about the right mindset of a trader. Now, talking about mindset, I'm going to show you how to create SRC profits. And SRC stands for systematic, repeatable, and consistent, because that is the key to long-term success in the markets. So, if you are sick of all the hype and empty promises, and you want to learn trading strategies that actually work, then click on like right now and let's get started.
All right. So we have an exciting session for you today. Let's go ahead and just dive right in. With today's episode, we're going to take a look at the markets. What's going on with these crazy markets? I'll review some trades that I'm in. We'll also discuss the real topic of the day, what to expect when the VIX spikes. And of course, we're going to be answering your questions. Now, let me first, let's just see what's going on in these crazy markets first. Let me go back here. I want to look at, there we go. So here we have the S&P. Unless you've been on vacation for the last month, you know that things are a little wild right now in the markets. Yesterday, best day of the year for the S&P, real nice rally. Today, sliding a little bit, although we're coming off of session lows here. If we look at a 5-minute chart, we opened up here, rallied a little bit, trying to fill that gap, made session lows right before lunch, kind of chopped around during lunch, and then an afternoon rally, finding some resistance near over or session highs, that is. We'll see if we can make another move higher in the next 20-25 minutes. But right now we are just above where we opened, down 0.6%. The Dow down 0.5%. The NASDAQ down 1%. So the NASDAQ leading the markets lower right now, down 1%. And if we look at the NASDAQ here, we see that we closed in a bear market territory. So what is bear market territory? Well, bear market territory is going to occur when we have a 20% drop from the high to the low, and we usually look at closing prices there. So we see here on Monday and Tuesday. Tuesday, actually, we're getting down to that 20% level. So we dipped into bear market territory for the NASDAQ on the day where Russia invaded Ukraine. But then we popped higher. We quickly reversed, moved higher, and then we got back down towards those levels. And now we're outside of bear market territory, defined by a 20% drop from the last high close to the current close. And now we're just kind of a little bit higher here. We could see that's a ballpark here, down about a little more than 18%, but outside of that 20% window. So we'll see what happens here. Looking at the week, with another trading day left, the NASDAQ is down 1.4%. The Dow is down 1.4% for the week as well. And the S&P is down 1.7%. So interesting, S&P leading the major indices with the losses for the week, although for the day, we see that the NASDAQ is leading the markets lower. So some crazy, crazy markets. We're going to talk about the VIX today. I just want to bring it up while I have my charts up, though. The VIX, aka the fear gauge or fear index, is trading at 31, so down 4% today, but these are elevated levels. We're going to get into this a lot more in today's session. but you see here that the VIX is at extremes. There have been spikes higher that have occurred over time, but we're definitely at extremes, and so that's something to be aware of, something to pay attention to, and to reference this 31 level based on what we're going to talk about today. Let's review trades that we currently have on. So Markus has an ARC F position. He did a partial rescue on this. He still has some other rescues to consider. I did not trade this, so I am not in this trade, but he has added to it a little bit. And ARC F down for the day, but off of the lows that were established 3 trading days ago. Markus and I are both in ADI. We've collected a lot of premium, and even though this one has dropped, our break even, I believe, is around 147, 147.50-ish, so we're still okay here, even though we originally got assigned at 162.50. We've collected a lot of premium over the last couple of months, and we're both in this one. Bank of America was a recent trade that we put on. Banks getting a little bit of a hit, financials in general taking a hit with the recent Russia-Ukraine news, and a little more of an exaggerated move than we initially expected. But we sold the 41 puts, collected some nice premium there. We also sold the 41 calls for this week after we were lower on Monday, but a nice quick bounce. I mean, yesterday and today flirting with the 41 mark, so we'll see if we get called away. But so far, that one's working out real nicely in spite of the volatility that we've seen recently. LVS, we were, this is one where we got in way back here. I would say that if you ever wanted to know what a rescue mission is, go back and look at some of the videos that Markus has done, because in my opinion, this is a picture-perfect way to manage a trade that has gone bad, right? With the wheel, we do have some tools in our trading chest to manage a trade like this in spite of a sell-off and bigger drop. And this is one where we made some adjustments to the trade. We were able to collect some nice premium here. Markus did another adjusted trade here where he was making some extra money. This fell a lot quicker than I expected to. So now we're down in this lower range. I'm still hoping that we could see a move back up to this range, ideally getting up towards these 46, 48 levels, although our break even is probably around here. So LVS we're in. Ride, hey, you know the deal with Ride. Ride hasn't been a fun one. Right now, it's really just all about news. There's a discussion on Foxconn's involvement. I think they need to make a decision by the end of April, and if that decision is positive, it could be that Ride spikes a little bit, but we are hanging on to this one for right now. No change, no adjustment there. Markus, he traded TPR, collected some nice premium on this one. He was able to sell the 47 put, also sell the 37 put and 37 calls. So this is one with that recent drop. Did see a little bit of an exaggerated move. Has come back nicely though. 37 is his line in the sand, and he's collected some nice premium. I did not take that trade. IWM is another one that Markus is in and I am not. IWM, he is assigned at 205. With all the premium that he's collected though, his break even is down here. So he's up on this one even though it's pulled back. Just collecting a lot of premium on this one. He hasn't sold calls right now, but he's targeting the 205. Especially if we have an update tomorrow or an update on Monday, might be a nice opportunity to sell some 205 calls. But so far, this is working out very nicely for Markus, although I did not take it. UAL, Markus and I both traded this one. Actually, this was from a while ago. I'm going to go ahead and remove that because we sold the 40 put recently. And this is where when we were talking about this one, I expected that this one was taking on a little more risk than usual. And in our mastermind group, I mentioned that this is a more aggressive trade because of the situation with Russia's invasion of Ukraine and oil prices, right? So we knew this. I believe there's some opportunity there, an opportunity, and when people are afraid, we're going to talk about that after this review. I believe that there's an opportunity to make money. So I went in this one knowing that there is the potential to see some volatility. I'll be honest, I didn't expect it to drop this quick. I thought that it could drop potentially, and if I got into the trade, if I managed to trade, I might be in it for a little longer than I normally am. When I get assigned, I'm usually in a trade for 25 days on average when I'm assigned, but those usually are the most profitable trades for me. And so I accepted that this one might be a little more aggressive. Didn't expect the real fast, sharp drop, but we sold the 40 puts here, and we got assigned. We're able to collect some nice premium because of the volatility in the market. We're down a little bit on this one. Nice to see that it's respecting these ranges that we had back here, though. Looks like there is some support, maybe 30, 32-ish. That's where we paused, and then we had a quick bounce higher. Would love to see this drift right back up to the 40 level so we could start selling some real nice calls on that one. But this is a trade that both Marcus and I are in. So that's a recap of the positions that Marcus and I are in. And we have collected a ton of premium in January and February. But there are some positions that we are assigned in right now that are down, or we're down but still above our break even because of all of the premium that's been collected. So, of course, we'd like to see things rally a little bit from here. But this is, risk transfer. We are willing to take risk appropriate for our trading and our risk tolerance and sell options, collecting that premium. We believe that that's the best way to trade and a great way to be profitable in the market and to reach your goals. And that's what we're still doing. So let's dive into the topic of the day, and then I will tackle these questions here. And I want to go ahead and go back to my slides. And we're just going to move on ahead here. So what is the VIX? What is the VIX? Well, it actually isn't a topical cough medicine with medicated vapors for soothing relief. It's not. This is actually what the VIX is. This is the VIX. And we're done. Have a great weekend, everybody. No, I'm not going to go through this math here. For anybody that really is a math whiz and wants to know how this is all calculated, you could take a screenshot and knock yourself out there. But the VIX is known as the fear index. It is a measure of market volatility, and it tracks the S&P 500 index options. And it represents market volatility expectations for the next 30 days. So you could look back and you could calculate exactly what historical volatility has been, but with future volatility, the best way to gauge that is with options. And if you think about it, options traders are making bets on underlying stocks in the market, right? So let's just take Bank of America as an example, BAC, right? We sold the 41 puts and we were able to collect some nice premium. We sold the 41 calls, collected some nice premium. Well, what happens when Bank of America is in a tight range, right? If it's usually in a $2 range for a month, trading from 41 to 43, maybe down, 41 to 42.50 and then down to 39.50. If it's trading in like a $3 range for the month, that's the expectation. If it starts to trade in a smaller range, right? Maybe it's trading in a 50-cent range, right, rather than a $1.50 range, then that means that options traders, whether they're buying or selling out of the money calls or out of the money puts, the expectation of the move is less. It's gonna, the expectation instead of moving in a $1.50 or $3 range for the month, it's moving in a tight range. That means that those options are going to be priced less, right? Because if options traders are thinking, well, there really isn't going to be a big move over the next couple of weeks, options buyers don't want to pay a whole lot for those options, right? So whether you're buying a call or buying a put, you don't want to pay a lot if the expectation of a move is small. Now, if there's this huge range, there's market volatility, there's uncertainty in the market, that's where options traders are willing to pay more because they expect bigger moves to take place, right? And so the VIX is essentially taking that idea, the pricing of these out-of-the-money calls and puts on the S&P 500 index options, and when those prices expand, the VIX is rising. And that's interpreting that information as implied volatility in those options, what the expectation is for a market move in the next 30 days. So it can be something that's valuable to get a better understanding of what potentially market participants are telling us, and also as an options buyer or seller, determining what makes sense, what we should be doing. So it's a very valuable gauge here, and if the VIX is up, this means that there is market uncertainty. And usually when the VIX is up, stocks are usually falling. When the VIX rises, usually stocks are falling because of this uncertainty, right? If the market is dropping, if the market is sliding, then the options are going to get more expensive because now people are thinking, well, what's the next step? What's the move going to be? If the VIX is falling, if the VIX is getting lower and lower and lower, this is when there's market stability. So yes, stocks are usually rising when the VIX is low, but that doesn't necessarily mean that the market can't drop, right? It could just be that the drop is within reason. Traders really aren't fearful of that move lower. So when the VIX is down, it doesn't necessarily mean that stocks can't fall, right? And that happens sometimes. When the VIX is low, the stocks are falling and people are thinking, gosh, what's going on? The VIX should be, it's really because at that point in time, based on options premium, that traders believe that the market is stable, even if it's falling. So these are just general rule of thumbs, but not certainties. The VIX is up, there's market uncertainty, and stocks are usually falling. When the VIX is down, it's the opposite, and the stocks are usually rising. So the standard rule of thumb here with the VIX is when the VIX is high, it's time to buy, and when the VIX is low, look out below, right? And so this just meaning that when the VIX is high, you can be a buyer. You could be a buyer when the VIX is low. Be careful because things are about to go crazy because we shift, right? From certainty to uncertainty, and we shift from uncertainty to certainty. And so that's the idea. But what I wanted to do is, aside from all of these rules of thumb, I really wanted to dive into what the VIX is telling us and actually look at the data. And what I did is I took the VIX over the last 10 years, and I went from January 1st of 2012 through March 8th of 2022. The reason why I went to March 8th was when I pulled the data, and I figured, I could have just gone 10 years and gone 3-8, but why not get a full year, right? Why not do the full year? Honestly, the data didn't change that much, but that's what the data that I'm presenting today is based on. Now, the average VIX was 17.23. So if we take all of the closing prices of the VIX over that 10-year period, the average was 17.23. Today, we were seeing a VIX of 31. So we know that the VIX is high right now. It's definitely high compared to its average, right? Now, the lowest that we had the VIX at over this 10-year period was 9.14, and this was on August 20th of 2015. And the highest the VIX was was 82.69, which was on March 16th of 2020 during the pandemic, right? So we have this pretty big range, but this VIX average, I think, is important, right? Because some people want to know, so what's normal for the VIX? Is it 10? Is it 15? Is it 20? Is it 25? What's a normal range? And I would say that 17, 1750, 17 to 18, historically, based on data, based on the last 10 years, is a normal average. Now, if we get spikes above 30, that's usually considered to be a higher volatility situation where there's market uncertainty. But let's keep going here. So 68% of the time, all of the data of the VIX in that last 10-year period tells us that the VIX is between 10.35 and 24.11. So this is just one standard deviation, right? Based on the average. This means that 95% of the time, the price should be between 347 and 30.99, right? That's two standard deviations. Well, we see that the lower level, we actually are encompassing a lower range there. But on the upper level, I think that 31 level is valid and something to be aware of in this market environment. So if we know that based on all of the data points over the last 10 years plus, since we have a couple of months extra, 95% of the time, the VIX was below 30.99. I think this is valuable information. It tells us something. We've had an extreme. So what are VIX extremes? Well, there are 2,563 trading days analyzed, and 563 days we saw that the VIX closed above 20. So 22% of the time, the VIX closed above 20. So that means that 78% of the time, the VIX was below 20, right? So we already start to see some extremes actually above 20. And remember, our average was about 17.25. Well, 110 days out of this 2563, the VIX was above 30. So actually, only 4% of the time did the VIX close above 30. We also know that two standard deviation upper value is about 31. So 30 to 31, that's an extreme. So that tells us that typically, at least based on the last 10 years, 30 to 31 is a rarity. 95% of the time, actually 96% of the time here, it was below 30. And then we look at a range of 40. So if the VIX closes above 40, this is an extreme situation. This only took place 37 days out of the last 2,563, meaning that 1% of the time the VIX was closing above 40. So that is a rarity. That is not typical. That is not common. That is an extreme. And I think that we could take this information and get a better feel for the markets, what could happen, and also where there could be opportunity, but also what we should consider as traders. Because I believe that many times traders overreact to something that happens 1 to 4% of the time rather than what happens 90% of the time, right? And I mean, this is just what we see all the time. Traders overreact, right? But this is the data. These are the numbers. So let's take the VIX and the SPY, because for me, the real question here is, how do the markets respond? Sure, the VIX might be high, or it might be low, or it might be at its average. But how does that impact our trading, right? How can we make money, or when should we be concerned? And so what I looked at was the VIX versus the SPY on those days. And at first I wanted to look at the most extreme situation. What happens after a VIX 40 spike and then drop back below 40? So if the VIX closes above 40, just to be clear here on what I was testing, I looked at what happens if the VIX closes above 40. And I wanted to know what the S&P did during that time between closing above 40 and closing back below 40. So what happens when we have the spike and this elevated VIX and fear in the market, and what happens when we drop back below? And I found that there really weren't many times that this happened, right? There were times when it stayed above 40 for a while, but the first time where it closed above and then dropped back below, it didn't happen too often. So on August 24th of 2015, it closed above 40. The very next day, it closed back below 40, right? So it took one day to go from above 40 down to below 40. And in this situation, the difference between the close of the SPY on 8/24 and the close of the SPY on 8/25 was $2.28. So it was a 1.2% loss from the time that the VIX closed above 40 and below 40. Now, on February 28th, when the pandemic was really heating up, it actually took 4 days. This date is incorrect. I apologize. But it took 4 days for the VIX to go from a close above 40 down below 40. And during that period, if you bought the SPY when it closed above 40 and then you sold the day that it closed below 40, you would have made $12.83 or a 4.3% return. Interesting. So buying the SPY when the fear is high returned a decent return here in just 4 days. Now, during that pandemic period, it was interesting because there were times when we closed above 40 and then we closed below 40. And so you had these stretches where we had more extreme volatility and fear in the market. Now, on March 6th, we closed above 40, and this time it took 26 days to close back below. So it closed back below 40 on April 14th, and this resulted in a $13.67 loss in the SPY, which represented 4.6% loss based on entering a trade on the SPY on the close above 40 in the VIX, and then closing that trade the day the VIX closes below 40. But then we see that it gets better. On April 15th, we closed back above 40. April 17th, 2 days later, we closed below, and this resulted in an $8.88 gain, or 3.2%. On April 20th, we closed back above 40. 4 days later, we closed below. This resulted in a $1.38 gain, or 0.5%. And then in June, we saw another elevated spike. It closed above 40. Then 1 day later, it closed back below. This resulted in a $3.60 gain, or 1.2%. And on October 28th, if you bought when it closed above 40 and then sold when you closed below 40, and again, this is tracking the SPY, you had a $3.32 gain, or 1%. So interesting. When the VIX is rallying and increasing, meaning there's fear in the market, traders have uncertainty, options premiums are getting expensive, the SPY actually didn't do too bad if you were looking at the extremes and a close back below. And I broke this down a little further. Well, what happens after a VIX 40 spike, then a drop back below? 71% of the time the SPY is higher during that period. There were times when it actually was lower, and then 5.6 days on average was the duration where it took to see the VIX go from a close above 40 to below 40. And this was a 0.63% average return if you were trading the SPY. Interesting. Well, I also wanted to see, okay, so what happens if we're not just going from 40 and then a close below? What happens if we close above 40 and then wait for a close below 30? And I did the math here, and I won't go through every single date because I just did that. But you see here that now it takes a little longer for the VIX to actually close below 30. If it's elevated above 40, it might be a short time for it to get back below 40, but it takes a little longer to get back towards that 30 level, right? And this, to me, it's revealing because there's an opportunity there, I think, when the VIX is spiking, right? And we see that here with the numbers. But it's not a real quick return back to normalcy all the time, because we see that we have 3 days, 49, 44, 17, 14, 14, 5. Now this was a little bit, it was a shorter duration than I expected, but it's a couple of weeks, right? Here are the returns. If you were to buy when the VIX closed above 40, and then you were to sell the SPY when the VIX closed below 30. And the takeaway here, well, 71% of the time the SPY increased when there was a spike above 40, and then the VIX dropped. And on average, it took 21 days for the VIX to go from 40 down back to 30. So about 3 weeks, on that elevated super high close above 40. And the return, though, was 2.8% over that 3-week period, about 1% a week. Not too bad. Not too bad. So then I looked at, so what happens if there's a VIX spike, a close above 40, and then it comes all the way back to 20? Remember that 17.25 or 21 is our baseline. That's the average, right? And we know that even 20 or higher doesn't happen all of the time when we look back at 10 whole years of trading. Although recently, I would say 20 to 30 might be more of a range that would be typical for us. Historically, 17-ish is the average, and 20 or higher would be a high VIX reading. Well, let's see what happens when we have the extreme spike and then we go to 20. Now, here is where it did take a lot longer to have that VIX drop and close back below 20. And again, I thought this was very revealing because it wasn't just this. We see these spikes, right, in the VIX, but for a big change in the VIX, it does take some time. Here we see that the returns are really nice, but it was longer during the pandemic to go from this extreme reading down to something that was a little more normal for historical data here. And here we see what happens after a VIX 40 spike, then back below 20. Well, 100% of the time, the S&P was higher, right? So if you bought the SPY when it spiked above 40 and you closed below 20, then 100% of the time, the SPY is higher. On average, 166, 167 days was what it took for the VIX to go from 40 down to 20. So you get those extreme spikes. It could be that we have some elevated, VIX for a period of time, but 28.4% was the average return. That's not too bad, considering, that's about 2/3 of a trading year, right? 252 days for trading, and not too bad. Not too bad. So anyway, I wanted to then look at something that was actually a little more normal. So instead of that extreme, what happens after a VIX spike above 30? And this is what we recently have seen. So this applies to what we're seeing right now. In fact, I'll see where today closes, but we haven't closed back below 30. But what happens after a VIX spike above 30, and then if we go back below 30? Well, this is just, a close above 30. What happens when we close below 30? And we see that it's pretty short term in nature, right? I'm going to just go forward to the takeaways here, but you see that the gains were pretty nice. And it doesn't take that long for it to close above 30 and then close back below 30 if we're trading the SPY. Not too bad here. Right now, we had a close above 30 on February 28th. We have not closed back below 30. And the takeaways, 88% of the time, the S&P was higher, right? So 88% of the time when the VIX closed above 30 and then we waited for it to close back below 30, the SPY was higher. And on average, it only took 5.8, let's say 6 days. On average, it took 6 days for the VIX to drop back below 30 and close below 30. And on average, for that 6-day hold, the return was 1.8%. Hey, not too shabby, right? So when everybody's fearful, when the markets are falling and people think that this is it, on average, there was some money to be made. The longest trade, the longest time it took for the S&P or the VIX, to close above 30 and then get its way back to below 30 was 50 days. And this was another thing that I thought was interesting. Although there were some periods where it took a while for it to close back below 30, 71% of the time, it happened in 3 days or less. I think that to me is really interesting. One, the average return when you're buying when people are afraid, and that typically it's a real quick pop back below. All right. So, the question here for me is, can the VIX predict tops and bottoms in the S&P? And this is where some people believe that to be true, right? You can predict bottoms, you can predict tops, and although we see that the VIX has been high when there have been retracements in the market, this is something that I think is a valid idea, but the data from what I see is it actually creates a buying opportunity where the market is more likely to move, not for the fear to kick in and there to be a huge sell-off, but for there to be opportunities to be a buyer. So I would agree it's better to be a buyer or to be selling option premium, right? So the same idea here, and this is why some people have said, oh, the wheel doesn't work in this market. And I would agree that you have to be more selective and be careful and not, it's kind of like buying stocks in 2020 after the pandemic crash. Anybody could have bought stocks and did well, right? Because stocks just moved higher, right? So you have a lot of rookies that actually put money in the market that had never traded before, and they saw 100% returns, and they thought that was going to continue. And they were trading some crazy stocks that just really didn't make sense, that were up 200, 300, 400% in a couple of months. And then they're holding on to those stocks thinking this is trading, this is the market, this is going to be great. And then instantly those accounts that were up, 100, 200% were only 50% what they started with because they weren't adjusting to a different market, right? I feel that in this market environment, the wheel is still a great strategy. And what we've seen in January and February is excellent premium collection. But we can't trade the wheel in 2022 the way we did at the beginning of 2021 or the end of 2020. And these are adjustments that we've made. Markus and I have both focused more on quality, focusing more on value, stocks that are more likely to hold up even if they do pull back in the short term, more likely to hold up in a higher interest rate environment, right? The markets have been responding significantly to the unfortunate situation in Ukraine and Russia's invasion, but there's still the Fed, right? The situation with inflation and the Fed has not changed, and the shift will go back to that with traders being concerned about interest rates. Short term, it's all about the Russia invasion, which turns into crude oil spiking, which turns into inflation, right? So it's like no matter how you spin it, it all comes back to inflation at this point in time. Even though it's horrible what's happening in Ukraine. So anyway, my point is that when there's fear in the market and traders are uncertain about what's going on, it's okay. I'm not telling anybody to trade like crazy and risk money that they can't afford to lose and to risk money that just doesn't make sense. But I believe that presents unique opportunities in the market. And you can be buying, just like I showed with the S&P. Typically, the S&P rises after these extremes, but also option premium is increasing, right? Because how does this impact our style of trading? Well, when you have higher VIX, higher prices for options are available, right? So you could collect more premium than you typically do when the VIX is higher, or even if you're collecting a similar amount of premium, you can sell puts at lower levels, right? So when the VIX was at, say, 15, maybe if you were selling puts at 100 on a stock, maybe you could sell puts at 96, right? So the stock's trading at 100, you sell the 96 put. When the VIX is at 30, maybe you're able to sell the 92.50 strike on a $100 stock, right? So you could get the same premium, but you have more wiggle room, you have more flexibility, and I think this creates some great opportunities, because not only can you start selling strikes at lower strike prices, but if there is a drop, and if it's a quality stock, it's more likely to see traders be buyers after that drop rather than seeing it just snowball and tumble. So anyway, I think that this is a unique opportunity for traders who have experience and are willing to take risks. When you have a lower VIX, you have cheaper prices for options. So in summary, I think that Warren Buffett, I think Warren Buffett put it first, or best. Gosh, I'm sorry. Be fearful when others are greedy, and greedy when others are fearful. Right? I couldn't agree more. And so I'm not saying, hey, you watch this video now, go trade, like crazy because you have nothing to fear. I'm saying that there's opportunity when markets are going crazy. There's opportunity, and maybe you being a buyer when people are scared can make you a lot of money. Or maybe selling options premiums to other traders, right? Providing, it's just like insurance, right? If you're going to get house insurance on the Florida coast, is it going to be cheaper when there's absolutely no storms headed your way, or when a Cat 5 hurricane is headed your way, right? Insurance is going to be more expensive when that Cat 5 hurricane is headed your way, and chances are everything's going to be okay, right? That's why the insurance companies are making money. They're charging more in that situation, knowing that yes, there might be some times where they have to pay out, but overall, they're going to be profitable. They're going to be making money. So anyway, I thought that this information was interesting, and it to me was a nice compliment to the presentation I did on the SPX and losing streaks that I did a couple of weeks ago. What happens when you have consecutive days that are losers, or consecutive weeks that are losers, and what the numbers say, what the odds say. Here we have the VIX, and for me, my takeaway is that there's opportunity to be an option seller, and there could be an opportunity to be a buyer when others are fearful. Excellent. So I know that there were some questions going on in the background, and some people had no idea what I was talking about today, and that's okay. To each his own. But let's see if there are some good ones that we need to touch base on. All right. Okay. Markus did a session on margin for anybody who has margin questions. Okay. You can watch that video. Wow, I guess I should have done a conversation on margin today. Or maybe it was only one person that cared. Let's see. All right. Yeah, Michael says, great presentation, but my head is spinning with these figures. I'll have to watch again. Michael, I presented the numbers to support my opinion, right? I think the takeaways are the most important, but absolutely watch the video again. I spent a lot of time going through those numbers and taking a look at things, and I thought that it was some interesting observations and summaries, but I think the takeaways there are the most important rather than the actual number by number. All right. Hey, appreciate that, Desmond and George and everybody that Scott, who's thanked me for the topic and the presentation. Thank you, Edward. All right. Yeah, Hopliophile 1. I think a lot of us keep an eye on it, but don't truly fully understand it. Yeah, and that's why I wanted to do the session here, because there are, some rules of thumb and ideas, but I thought it really made sense to do a deeper dive and really see what happens when you have these extremes. Yeah, Jay says he's been using the wheel in up and down market, and it's really finding the right stock. That's key. Yeah, agreed. Wonderful. All right. Well, I know we're right at that 45-minute mark, and that was fun. It's fun filling in for Marcus. He's going to be back in action with the next coffee with Marcus, but it was fun to sub for him. I hope that you got a lot of value out of today's presentation, and if you did, please like the video, and if you're not a subscriber, definitely subscribe to the channel. There's a lot of good stuff there. But like the video, that way I can compete with Marcus and give him a bad time if I have more likes. We always, with the mastermind group, we always have a little friendly competition there. So anyway, hey, have a great rest of your day, a great trading day tomorrow, and we'll see you next time.